China is currently experiencing an economic winter characterized by a shrinking population, an aging problem, high unemployment rates, and a sharp decline in foreign direct investment. In light of the real estate crisis in China, highlighted by Evergrande's bankruptcy, people are choosing not to buy homes and developers are not purchasing land. Apart from China's economy, Australia's will have a direct impact. China's steel production accounts for more than half the world's total output, surpassing the combined total of the next 9 largest producers. Of the steel used domestically in China, 1/3 goes into residential construction. This is where the connection to Australia's economy comes in. 60% of the iron ore used in China's steel production is sourced from Australia, and 85% of Australia's iron ore exports go to China. In 2023 alone, this trade brought Australia $105 billion. If the Reserve Bank of Australia's estimate holds true, and by 2050, the amount of steel used in China's construction sector drops to 1/6 of what it was in 2019, the iron ore exports that have been a cornerstone of Australia's GDP and government revenue could completely dry up. Does this mark the end of Australia's 30-year mining boom? Has Australia's economy entered an entirely new cycle? And will the Australian real estate market face a ripple effect, leading it into an era of slow growth? Hi, I'm Alex. Welcome to Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Normally, I don't pay much attention to topics like China's steel production capacity and Australian iron ore because they don't seem directly related to our everyday lives. However, 2 weeks ago, the governor of the Reserve Bank of Australia made a speech in Parliament expressing concerns about Chinese economy, which brought this topic to my attention. So what does this mean? I've noticed a new trend, and unfortunately, it's not a good one. The RBA governor stated that the continued decline of China's economy could significantly weaken Australia's economy and further drive down iron ore prices. Since the beginning of this year, iron ore prices have fallen from $144 per ton to around $98, a drop of more than 32%. This creates a double blow to Australia's iron ore export revenue and federal tax income. In fact, the federal budget surpluses in 2023 and 24 were not due to a strong Australian economy, but were supported by 3 factors: iron ore exports, coal exports, and bracket creep in income taxes. None of these are related to increased productivity. They're all external factors beyond our control. In reality, Australia's economy is already in poor shape. It's just barely holding on, thanks to a bit of luck. In the same week as the RBA governor's speech, Hu Wangming, the chairman of China Baowu Steel Group, the world's largest steel company and a Chinese state-owned enterprise, issued a warning at their mid-year performance review meeting. He said, "The harsh winter for the steel industry may be longer, colder, and harder than we expected. This year, due to the downturn in the real estate market and weakened industrial activity, domestic demand in China has been severely impacted, with steel prices plummeting to multi-year lows and steel mills facing heavy losses. The Chinese steel industry experienced severe downturns during the global financial crisis of 2008 to 2009 and again in 2015 and 16. These crises were ultimately addressed through massive stimulus measures. However, looking ahead to 2024, with the Chinese government's efforts to reshape the economy showing limited success, the outlook appears even more uncertain. What's interesting is that these fluctuations in the steel industry have been directly tied to the rise and fall of Chinese real estate sector. Many people believe that since the real estate market was commercialized in 1998, housing prices in China have never declined and have always been on the rise. However, beneath this general trend of increase, housing prices have actually experienced 4 significant declines. The first major decline occurred around the time of 2008 global financial crisis. Starting from the adjustment period, housing prices in China fell by more than 30%. In Beijing, on-site surveys showed that the price in many areas dropped by as much as 40%. Of course, you won't see this reflected in official statistics for obvious reasons. In response, at the end of 2008, the government introduced a 4 trillion yuan, roughly 890 billion Australian dollars, investment plan to boost domestic demand and stabilize the economy, which was essentially another form of money printing. The impact was immediate. Housing prices began to rebound at the beginning of 2009. In just 1 year, prices in some areas even doubled. During this period, domestic steel prices also fell sharply, but iron ore imports were not significantly affected. Steel companies anticipated government intervention and, knowing demand would eventually return, continued importing iron ore as usual. The market rescue allowed production to return to normal. Australia was quite fortunate as iron ore exports were not impacted by the 2008 financial crisis, and the subsequent increase in demand a year later injected new vitality into Australia's economy, helping the country weather the crisis safely. The second significant decline in China's housing market occurred in 2014. A notable event was the sudden drop in housing prices in Hangzhou in March that year. The drop was considered sudden because it occurred without any specific suppressive policy measures being introduced at the time. Hangzhou's housing price decline was seen as China's first market-driven adjustment, a direct reflection of supply and demand. Some even believe this marked a turning point toward market-oriented housing prices in China. From March to October, housing prices in Hangzhou fell by 30 to 40%, and the downturn quickly spread, leading to a nationwide adjustment in housing prices. Prices in Beijing fell by about 20%, and the nationwide trend was similar. Starting in August, Hangzhou began to intervene, completely lifting purchase restrictions, aggressively promoting urban renewal projects, and benefiting from the central bank's interest rate cuts and reserve requirement reductions. Housing prices rebounded quickly, first in the largest cities, followed by second-tier cities, and finally, third-tier cities. Again, thanks to the government's timely intervention, steel production and iron ore import volumes were not significantly affected. Following this wave of price increases, many cities saw housing prices double again. This prompted a new cycle of real estate policy regulation, which was more prolonged and severe than ever before in China's real estate history. Beijing's March 17, 2017 new policy was particularly stringent, using every tool available, including purchase restrictions, loan restrictions, price caps, divorce restrictions, and 3 red lines policy, and centralized management of mortgage quotas. From 2017 to September 30, 2021, the regulation remained tight, only loosening after the Evergrande debt crisis. Nearly 5 years of regulation combined with the cyclical shifts within the Chinese real estate market transformed the threat of rapid price increases into a crisis for the entire industry, leading to a third major adjustment in housing prices. After Beijing and Shanghai introduced stringent regulatory measures in 2017, housing prices were the first to adjust, with actual declines of at least 15%. Many people in Beijing who bought homes during this period felt this acutely. At the time, some were persuaded to buy properties in the areas surrounding Beijing, causing those housing prices to surge. However, without any substantial support, these properties often saw their prices drop by half from their peak. After 2 years of adjustment, first-tier cities saw another rebound in 2020, especially in Shenzhen, Shanghai, and Guangzhou, where housing prices rose significantly. In Shenzhen, the price surge could even be described as a boom, prompting the introduction of more stringent measures to curb prices again. Behind the rebound in a few cities was a crisis for the entire industry, leading to the most significant, real, substantive adjustment in China's housing prices to date. During this period, international iron ore prices declined for some time. If you still remember, this period marked not only a downturn in China's housing market, but also 2 challenging years for the Australian economy and real estate market. In 2021, after China achieved record sales figures in real estate, the industry took a sharp downturn, and people lost confidence entirely for the first time. Despite numerous real estate stabilization measures implemented since September 2021, such as removing the 3 red lines, lifting purchase restrictions in some cities, mortgage rates for first-home buyers dropping historically below 4%, a later 1 trillion yuan stimulus package, lowered payment requirements, reduced interest rates, and direct government purchases, the overall activity of the industry remains low, and confidence is still lacking. From January to July 2024, the total sales value of new residential properties in China fell by 24.3%, the total areas in square meters sold declined by 21.1%, and nationwide residential real estate development investment dropped by 10.6% year-on-year. Simply put, no one is buying homes and no one is building them. China's previous 3 significant housing market declines all featured dramatic rebounds driven by various market rescue methods. However, the current 4th decline offers no chance of returning to the previous real estate boom, as this is not a cyclical market adjustment, but rather the onset of an entirely new era. Reason number 1, population ceiling. There's a widespread social consensus that China's 1.4 billion population has reached its peak. In 2023, the population decreased by 2.08 million. Once the decline begins, it's difficult to reverse for several decades. Number 2, urbanization rate. China's urbanization rate has already reached 65%, with some provinces at 70%. In comparison, Europe and the US are at 75%. In China, urbanization primarily involved relocating young and middle-aged people from rural areas. Further growth might add just another 5 to 6%, limiting the increase in urban housing demand. Number 3. Aging population. Over 20% of China's population is already aged over 60, and by 2030, this will surpass 30%. By 2050 or 60, it could reach 40 to 50%. The more elderly people there are, the fewer houses are needed, especially as more people pass away, which will release additional properties back into the market. These indicators will affect the housing structure and significantly reduce the demand for new homes. Number 4. Excess inventory. China has a total of 40 billion square meters of housing, with 30 billion square meters of newly built properties since the 1990s. Out of these, 6 billion square meters are idle, not sold, not rented, and sit there. As long as property prices continue to rise, this idle inventory isn't a problem. However, if prices stagnate, this excess inventory will lead to significant oversupply and a sharp decline in demand. Number 5. Per capita living space. In 2019, the per capita living space in China was 48 square meters, which increased to 50 square meters by 2020. In developed countries like Europe and the US, 50 square meters per person is considered the upper limit. 40 years ago, China had only 5 square meters per capita. Now it's 50. They've reached the ceiling. Number 6. Housing construction boom. China built 100 million square meters of housing in 2000, which grew to 1 billion square meters by 2010 and 1.7 billion square meters by 2016 to 17. In 17 years, housing construction increased 16-fold. This has reached its limit. These 3 indicators show that supply is too high, and both the per capita living area and construction volume are excessive. Number 7. Soaring land and real estate prices. Over the past 20 years, land and real estate prices in China have increased 16 to 20-fold. Yes, you heard that right. Not 20%, but 20-fold. Nationwide, land prices have increased the same over 2 decades. With this trend, all real estate developers hold properties, confident that prices will soar within a few years, even if unsold. This leads to oversupply, and excessive borrowing creates a massive debt burden, threatening China's financial stability. Number 8. Educational and healthcare infrastructure. The development of facilities like schools and hospitals in cities have also reached its peak, including an oversupply of universities. In the 1980s, university students in China had an average of 10 square meters of campus space per capita. The Minister of Education set a standard of 50 square meters per student. Now, with over 3,000 universities in China, the average has reached 50 square meters. There's no need for further expansion. Number 9. Real estate financing. Chinese real estate developers have debt ratio of around 90%. No one can operate with zero assets. Developers' leverage has gone from 10 to 20% to 80 to 90%, which has already reached its ceiling. Even after another decade, it won't reach 105%. Considering these factors, I believe that the current downward trend in China's housing market is not merely a cyclical market adjustment, but the beginning of a new market phase characterized by an overall decline in actual demand. This explains why repeated aggressive market stimulus has had almost no effect. This shrinking demand in China's real estate market may persist for 20 to 30 years. Now, as China's economy enters a new phase, does this mean that Australia's 30-year mining boom is also coming to an end? Early in this video, we mentioned the 3 main factors behind Australia's budget surplus over the past 2 years: iron ore exports, coal exports, and bracket creep in personal income tax. Suppose the more critical factor, iron ore exports, along with other major commodities, fail to sustain high prices and see both volume and price declines. In that case, coupled with Australia's own lack of improvement in productivity, making it impossible to generate more output, Australians will struggle to become wealthier. Some might suggest bringing in some immigrants, the so-called quantitative peopling, to solve this issue. Unfortunately, that won't work. Data from the past few years showed that while an increase in immigration has slightly boosted Australia's overall GDP, the actual per capita GDP has been declining. This is known as per capita GDP recession, where individual living standards are falling, and it's something people genuinely feel. To win votes, the federal government has already pointed the finger at immigration as the cause of Australia's economy woes and the decline in living standards. Both the ruling and opposition parties are moving further towards reducing immigration numbers. Therefore, the only ways to keep the Australian government running smoothly are 1. raising taxes, 2. Cutting public spending, and 3. Borrowing more money. Each of these options only further drains Australia's economic future. Australians will not welcome high taxes. If the government continues to raise taxes as aggressively as the Victorian government has, do you think they can still win the next election? Cutting public spending on healthcare, infrastructure, and welfare is equally unpopular. Borrowing seems to be the only option left. Over the next 20 years, everyday Australians will likely see higher taxes, fewer welfare benefits, and an era where debt quietly becomes unmanageable. This era will be marked by a downgrade in consumption and tightening of belts. Despite this, Australians will want to work less, avoiding answering work calls after hours, and continue to lower productivity. So I really don't see a clear path forward for the Australian economy. Now the question we care about most arises. Will Australia's real estate market be dragged down by the economy in the future? What should property investors do? First, let's rule out black swan events, major shifts in international relations, or the impact of disruptive innovations, assuming that current conditions remain unchanged. How will Australia's real estate market look in the future? Does the state of the Australian economy have a direct impact on housing prices? On this point, we have had an in-depth discussion on our channel before, and the answer is there is no direct impact. By studying Australia's economy and housing price history over the past 30 years, we've found that when the economy goes up, housing prices can either rise or fall. The same is true when the economy goes down. There's no clear positive or negative correlation because Australia's housing prices are driven by supply and demand. Both the supply and demand sides are influenced by multiple overlapping factors. For example, during the pandemic, even as the Australian economy was in recession, housing prices skyrocketed. The impact of the Australian economy on the real estate market is more underlying, slower, and more subtle. Australia's population is set to continue growing over the next 20 years, primarily driven by immigration. Although the current trend is to reduce immigration numbers, this is only a short-term situation. In the long run, once Australian politicians no longer have GDP growth as a political achievement, they will likely initiate another era of large-scale immigration, trading less per capita wealth for overall GDP growth. However, as we've discussed in previous videos, even if immigration would reduce to zero, housing demand would still continue to grow, supported by the trend of smaller household sizes and a stable natural birth rate. The Australian real estate market will continue to develop in the future, but this development will likely rely more on fiscal stimulus policies and higher debt ratios. The long-term trend of overall price increases will not change. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye.